Well, good Monday morning and welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. We've got a great guest today. I'm excited to get into the conversation with him here in just a sec. But first, let's thank our sponsors over at Accelerate. So if you're looking to close out more loans in 2021, make sure, if you haven't already, to experience Accelerate's award-winning customer engagement platform that features lead management, CRM, call routing, sales enablement, marketing automation, borrower engagement, and data intelligence through innovative use of multi-channel marketing. And that's text, social media, email, direct mail, phone, ringless voicemail, retargeting, and much, much more. And as we always say, make sure to hit the follow button on Josh Friend on LinkedIn. Great content there. He's always active on LinkedIn. He's got a lot of great stuff he's putting out there. And if you want to schedule a personal demo for Accelerate, make sure and go to accelerate.com and you can do that there. All right, let's jump into the conversation. I'm excited to welcome in our guest today. We're talking about our monthly theme this month, I should point out. We're going to be talking about secondary capital markets issues all this month. And so I'm excited to welcome in today's guest, Jim Glennon. Jim is the Director of Secondary Services in the Secondary Marketing Technologies Group at Black Knight. So Jim, welcome.
Thanks for having me, Dustin. Thanks everybody for watching. Good to be here.
Yeah, Jim's an old friend of the association. He's been one of our speakers at the Secondary Market Conference for years and years. If you've attended that in San Francisco this year, it's going to actually be in Dana Point, and it should be a fantastic event. Just a little plug there for a second. Registration for the Western Secondary opens up on June 15th. So if you've been itching to get back in person and shake some hands and see some folks at the Western Secondary, you can register on June 15th for this year's conference, which will be August 24th through the 26th in Dana Point at our new location at the Waldorf Astoria Monarch Beach Resort there. So Jim, let's start with you with your background there. Tell us a little bit, for those that don't know you, tell us about yourself, how you got involved in the industry, and what's led you to your position there at Black Knight.
Yeah, so like most people in this industry, I didn't plan to be here. I didn't go to school for this. I'm also not a masochist, but here I am, right? So I started, looking for a job out of school back in the early 2000s when we were fresh off the dot-com bubble and 9/11, and kind of a tough environment to get a job, and answered an ad for a loan officer position. I didn't really exactly know what that meant, but the HR person gave me a call and said, our secondary head of secondary thinks you'd make a good fit for the lock desk. I said, great. I have no idea what that is, and she didn't either. But I interviewed for that, and that's how I got into the industry. From there, I've worked at a couple local mortgage banks here in Denver over the years. Neither of them exist anymore, as is the deal, with those of us that made it through 07 and 08. We kept my head down during that time, like a lot of us, and just kept working and stayed in the industry. It certainly contracted at that point, but once you get through that, I feel like we all need to stick around and see how things are really gonna pan out. So I knew Don Brown very well early on in my career when he was with Flatirons, and he founded Secondary Interactive. A lot of you may be familiar with that hedge firm that then became OB, Optimal Blue Secondary Services. And then now we're with Black Knight. But Don hired me in 2012, and we built, since then we built an amazing team here in Denver. I think when I started there was about 6 of us on the desk, and now we're close to 30. And then now we've combined with Compass Analytics as well under the Black Knight umbrella, and really building. And we've already assembled the largest hedge firm in the industry.
That's got to be a huge transition going from, in a pretty short amount of time, going from 6 people in an office to now you're part of a huge company that's got their fingers in many different aspects of the loan life cycle. And you're still there. You've probably you got some old OB folks in there, but you're now combining with, like you said, with the Compass folks and Black Knight folks. What's that been like, just transition wise for you?
It took years just to learn all the products that Optimal Blue had, from 2012 on, and we were acquired in September of last year, so it's still drinking from the fire hose, right? We've had some webinars over time where we've learned about Empower and all the other different products that we offer. And I still have no, very just cursory understanding of even what which parts of the industry we're in. But it's been fun. Certainly been great to meet new coworkers, especially the Compass folks, right? We speak the same language as each other, and we know a lot of the same people, and we encounter a lot of the same personalities and opportunities and fun stuff, but also the same challenges. So that's been great, just to get to know who was previously one of our biggest competitors, just getting to know them, and hopefully soon in person, getting to know them personally. It's been really great to compare stories and get to know each other.
Yeah, this is kind of like, if I'm using the baseball analogy, this is kind of, Dodgers Giants. You guys suddenly are, on the same team and shaking hands, and the ice is melted, huh?
Absolutely.
So, I mean, this may answer this. You may have already answered my next question here, but I mean, this last year has obviously been, to say the least, a challenging year for many folks, for everybody, I should say. But certainly you guys have had not only the challenge of COVID, but as you pointed out, the challenge of the merger and the transition you guys are going through. So what's been maybe the biggest lesson you've learned in the last year?
I mean, probably a couple of big ones, right? I mean, one is you have to be ready for anything. Last year was certainly a great example of that. Just in this, just speaking in terms of secondary marketing in the mortgage industry. I mean, nobody saw the pandemic coming, I don't think, at least not how it was going to affect the mortgage industry. So understanding, making sure you have all your executions, just a plethora of executions open to you. Broker dealers, making sure you've got, a lot of liquidity there, being ready to scale, making sure that your technology and your operations are ready for an onslaught of volatility, for an onslaught of volume, to be able to triple volume almost overnight. But I also learned, personally, and just, from the team and everybody within Optimal Blue and all of our customers, that you can get through anything, right? You can adjust, you can adapt. And we were probably, as an industry, in a pretty good position to do that, whether it's through technology or just, having been through 07 and 08 and just being kind of like emotionally ready for another 10-year roller coaster.
Right.
So yeah, I think those were the big things. It's just, you have to be ready, and then you have to adapt. But then we did, hopefully are through it at this point. But transitioning to working from home, all of our clients trying to do the same, working through the market catastrophe, and then kind of then riding the wave of triple volume.
Yeah. So do you think that, I mean, looking back, is there something, I'm sure there are many things that, companies, could have, would have, should have done differently. But, let's assume in an alternate universe, we have to go through this again, in 5 years. What do you say, what would you say as far as, the lessons you've learned over the last year? How would that apply if we had to go through a similar, maybe not a pandemic, but a similar, shock to the system, and kind of things kind of shut down for a year? I mean, what changes what would we do differently?
That's a good question. Even in hindsight, there were a lot of different strategies that people took on, and there were some that worked, and there were some that didn't work as well. Everybody made it through somehow, through the margin calls, through the volume onslaught, through some of the dislocation in mortgage pricing versus the MBS market. The most successful ones just kind of kept their foot on the gas. Even as things were, we kind of had an existential crisis there for a good month, right? Where we had mortgage banks in the industry that were talking about whether they should even be originating mortgages, and that was a real question. And there were investors that were potentially not going to buy loans, and there were certain types of loans that disappeared overnight, and co-issue buyers that got out of the business. But it was the mortgage lenders that literally just kept the foot on the gas. Keep bringing loans in the door. Make sure you're monitoring and managing your price to what's going on in the market. Everybody took a little bit of a financial hit in March and April, but then, starting in the summer, you saw record gains, record volume, and just, kept a close eye on things like data. What exactly is the market doing that people aren't coming out and saying, right? What is the data telling us? So I think, if we had to do it again, looking at the data sooner, looking at more of it, but it's a lot of things we do anyway, and you don't know where the next catastrophe is going to come from. So you may not, you basically have to be looking at all of it.
Right, right. And I think you mentioned the margin calls. I think that's something from an association or policy perspective. I mean, that I think it would have helped to have alerted policymakers sooner that how big of an issue that was going to be and how quickly they needed to step in and ensure that we didn't have the catastrophe we almost had. As bad as things were, I mean, I'm sure it could have been a lot worse, in March, April.
Yeah, it was right on time from what I recall. I believe it was a Monday when the Fed buying finally slowed down. And the word was that the MBA finally, they got word up to the Fed that you guys need to slow down. Like, I don't think the Fed they had a sledgehammer out and they were beating doors in, and they didn't have a full understanding of what they were doing to the average mortgage banker. So that was a invaluable voice that we had that otherwise would have come way later, right? The Fed would have caught word months later that a record number of mortgage banks went under in 60 days, but rather instead it was a 5-day run up, and then the screaming made its way up the chain. And looking back on it, it's probably pretty efficient that it happened in 5 days. But sure, if we had to do it again on day 2, we probably would have said, "Uncle,"
Yeah, absolutely. So as as this year, goes on here in 2021, it seems like the refi boom is certainly, either starting to wane, or in some cases is already on the wane and starting to head into the background. And we're moving back into a purchase focused market for sure at some point here this year and next. So what should lenders, as that transition happens, what should lenders keep in mind from your perspective?
I mean, you got to dust off a playbook, right? We've been through this market. We've been through this business cycle before. Getting back into the purchase market, you got to, take a look at your realtor connections, your builder connections. Get back into those purchase leads. Just make sure that you have some purchase business and start to try to grow that, right? The refi business is almost certainly going to shrink unless rates go quite a bit lower, maybe even lower than they were last year. Almost everybody has refied by now. And if rates go up a little bit, that's going to slow down the few, stragglers that are hanging out there. So there's that. And then I think just getting creative on product, right? The fish have been jumping into the boat, so to speak, for the last year and a half. So conventional and government, right, is a pretty easy business to do when things are good. But, I think we'll start seeing more jumbo, we'll start seeing more non-QM, non-conforming, things like that, just to supplement some of that business, and even maybe bring in some higher margins on some things that are a little bit more creative.
Yeah. So to that end, what does the jumbo and the non-QM market look like a year from now?
Bigger, certainly bigger. I think again, lenders will have to get creative, and so will investors. There's certainly a decent amount of investors out there still that have either survived or popped up since the pandemic first hit. And we've seen more private money come into the market, even just with some of the PSPA stuff, right? The non-owner occupied loans being pushed back on by the agencies. The agencies are generally, by way of the Treasury, pushing back on certain types of loan scenarios. We're going to have the QM patch finally expire. So there's this sort of, artificial influence there that's going to push more into the, private securitization market. But I think with volume drying up, we're also going to see just an opportunity there for buyers and securitizers to come in and develop new products and grow what they're already doing.
Right. Do you think that we're going to see more individual players join the market, or is it just going to be a matter of the existing players, further concentrating their power and expanding their own volume?
If I had to guess, I'd say both. I think it's probably going to be difficult for all of the existing buyers to grow enough to take up, if the volume shows up, I suppose. But if you look back to like 2011, 12, 13, 14, we went from, even on the agency side, like 5 investors to 40. This may be that opportunity to do that as the agencies or, the government tries to shrink the amount of volume that the agencies are responsible for. It seems like there's this enormous opportunity for private money to come in and I think the mortgage industry weathered this last crisis a lot better than '07. So there isn't this stigma attached to mortgages where folks just don't want to, like, who wants to, back then, who wants to start a non-QM business? Who wants to start a mortgage business that isn't guaranteed, at least implicitly, by the government? But now, maybe we've gone long enough where that amnesia has set in, and we're willing to take that chance.
Right. No, that makes sense. So, moving out to maybe a more macro view here, what's, from your perspective, what's the latest from the Fed? What should we be keeping our eyes on? I know there's some inflation issues that we're seeing in headlines right now, and maybe we'll get to that here in a second. But, what are you keeping your eye on right now?
I mean, it's the Fed. It's always been keep your eye on the Fed, right? I think right now, and always, for the last 10, 15 years, the Fed knows that all eyes are on them. They know that any sudden moves are a potential problem for the market, or could create undue volatility. So that, they're going to keep their eyes on the dual mandate, right? Watch unemployment, watch inflation. And right now, employment is running a little bit slow, right? We're kind of missing numbers. There's a ton of job openings out there, but we're not seeing those jobs get filled. So I think that'll happen over time. I think people are probably just being a little more selective about the jobs that they take now that they're re-entering the world from the pandemic, and maybe looking to change things up. So that'll take hold, and then inflation's the other piece, right? Which we're seeing some heightened inflation numbers, but the Fed right now believes that that is transient, right? It's temporary. That's mostly due to supply issues because of the pandemic, and the fact that everybody's now coming out of their houses into the world and then going on vacation and things like that. Yeah, I mean, the Fed, currently believes that the inflation numbers we're seeing right now, and the inflation numbers we might see even the remainder of this year, that inflation pressure is probably transient, probably temporary. There's still supply issues due to the pandemic, and at the same time, you've got the world opening up, so you've got folks coming out with a lot more demand to go on vacation or to go out to restaurants and to buy things. So there's this blip in prices. But the Fed is basically kind of standing, holding position on that right now, and then saying this looks transient. We're not going to act early. And I think the Fed has learned from history that acting too soon to make moves to slow down inflation can be dangerous, right? There's, if you look at the European Central Bank in 2010, coming out of the Great Recession, they may have moved a little bit too quickly to preemptively stave off inflation, and that led to some economic problems, or led to kind of a double dip, and contributed to some of the defaults in like Greece and Italy, and some of those debt problems because they raised rates too soon. So I think the Fed's going to look at things like that and really going to wait to see major sustained inflation before they make any moves. So we're not expecting. We, like, the economic consensus is that you probably won't see rates go up till 2023. Ish.
Do you think that how long do you think that maybe not the Fed, but how long does Jim Glennon look at the situation right now? And I mean, that you mentioned that inflation may be a transitory thing or a temporary thing. How long does that go on before you think, okay, maybe this is not necessarily temporary? Is that like 3 months or 6 months or?
I don't know. Yeah, that's a good question. I think it's probably in the details somewhere. Where's the inflation coming from? What part of the what industries are driving it? Is it making its way into wages as well? Kind of a full picture of inflation. That's a very difficult balancing act that the Fed's going to have to deal with here over the coming months and years, as it relates to whether or not they want to raise rates. Or the other thing we need to be looking really closely at and be careful about is the the asset purchases. When does the Fed start talking about tapering? There's been whispers of it in the previous meeting. I think they said they basically wanted to talk about it in a future meeting, right? But that means, and we all know it's coming. But as soon as the word taper or a synonym comes out of somebody's mouth, that's when we'll start seeing issues with mortgage rates.
Gotcha. So then, if the Fed's going to hold, as you said, a hold position for now and sort of wait and see, how does that change, or should that change strategies and outlook for lenders?
I mean, the Fed hasn't flinched yet. And again, the Fed has learned from history that they realize their influence. I think there's going to be a lot of care taken not to create any undue volatility, but we will see it here and there, right? We saw some volatility back in early March when the market sold off on some inflation and some words from the Fed. I think the strategy almost needs you need to be consistent, right? I mean, keeping a neutral position if you're when you're hedging and when you're managing secondary marketing department is always going to be an overarching theme, right? Just keeping your position safe, right? I think during the pandemic, we definitely saw some mortgage banks take positions to the long side, right? Just assuming that the Fed was going to be in it for 12 to 18 months. And that turned out to be true, right? So it wasn't the risk to the downside was smaller, but I think at this point, the risks are probably about equal, upside, downside, maybe a little more risk to the downside, meaning rates should go up in the next 12 months, right? So a long position would not be advisable. But otherwise, it's volume is the big thing to try to be ready for as best you can. No matter what happens, we're almost certainly due for a continued contraction in the market. So anything you can do to prepare for that, technology-wise, scalability-wise, and it's just product and where your leads come from is going to be important as well.
Makes sense. Makes sense. So if we're looking at, I think this is I'm really curious to find out what you think about this. So I mean, everyone's looking, when you pick up no one's picking up a newspaper. When you click on whatever your favorite news site is, everyone's watching rates, everyone's watching unemployment figures or GDP. What is, from your perspective, what's the most underappreciated stat that lenders should be paying more attention to than maybe they do?
I think it's, as far as lenders, I think it has to be a little more specialized, right? I think, the old school view was watch the economic data, certainly keep an eye on the Fed. But I think now there's so much readily available data on our industry that's the kind of thing we need to be paying as close attention to as possible, right? And again, a lot of this, the theme is competition is going to pick up, volume is probably going to be down or at least be stagnant. Just understanding as a lender what your market position is, right, versus your competitors. Keeping an eye on your profit margins, and maybe even more important, your concessions, right? We start getting into a zone now where for the last 18 months it's been pretty easy to bring in margin. Concessions to pricing have been relatively low or sometimes non-existent. Again, fish jumping into the boat. But if we see volume cut in half by later this year, early next year, it's really just making sure that you're still making enough margin per loan to keep the operation profitable. And then things like free extensions and just generally the things that happen during the really fast times that you'll need to take a wrench to during when things get a little tighter and things get a lot more competitive.
Yeah, no, it makes sense. So let's switch gears here for a minute here. We've only got time for maybe one or two more questions here, but I'm curious. I mean, I think this is right up your alley here. I mean, you've been sort of right at the heart of the industry's movement towards increasing technology usage in secondary market operations in particular. So, how is technology changing those strategies, and maybe what's the biggest driver of change in that realm?
I mean, it's data and integrations are two of the big things that I think are really driving a lot of the changes. Over the past few years, they're going to continue to make companies more scalable, make companies more competitive, just give lenders more visibility into their market, where they're lending, just being able to organize their operation better. Relative to what we were just talking about, understanding the competition down to a granular level, understanding your profit margins versus your competition, then understanding market liquidity in terms of investors, right? What investor prices are out there? Where's that liquidity? What investors are positioned well in the market for the type of volume that you're doing. And then, when it comes time to sell loans. There certainly have been advances there over the past few years that made that made the pandemic a lot easier than it otherwise could have been. You've got things like, all the trading platforms that are out there for trading whole loans. If you go back 4 or 5 years, we were trading loans over the phone or via email, which, given what's happened in the past year and a half, I don't know that would be feasible with near the same amount of people, right? It probably would have taken a 3 scale increase in the amount of bodies that you throw at trading, period. Then you have things like the agencies have come out with S&P for Fannie Mae and cash exchange for Freddie Mac. So just making co-issue a lot more streamlined and a lot simpler. Just the agencies and the investors have come out with a lot of technology that makes loan delivery a lot simpler no matter how you execute. So that allows you to keep a very broad stable of buyers in the game without having to spend a lot more time on any one of them, or without having to train people, or without having to go through some of the headaches that it used to take to board a new investor.
Yeah, no, it makes sense. And I mean, if you're a lender, I have to imagine this has got to be helpful in the sense that as you point out, you can have, fewer bodies working on this and maybe more bodies, on the origination side, bringing in more business.
Absolutely. It's, again, the volume thing, right? As we slow down, you want to be able to do, smaller volume with the same amount of folks and have the technology do most of the heavy lifting. And the next time we hit another spike in volume, we're right there. And maybe during that time, we've tightened some things up and we've implemented some new technologies. And certainly the industry will be more efficient, and investors will be more efficient at that time too.
Exactly. Yeah. So let's close with this. I mean, you kind of touched on it earlier when we were talking about the margin call issue last March, April, and I think it's important to touch on this here. So why is it important for lenders and solution partners like Black Knight and to support the advocacy work of groups like the California MBA and the National MBA from your perspective?
Sure. I mean, everybody needs a voice, right? I mean, the government can't possibly understand every industry and every business that's out there in detail. There's probably almost zero that they do. And they have a very blunt instrument when they step in to try to affect change. So this last year's been a great example. We talked about the margin issues, right? If the MBAs had not stepped in to get word to the Fed, if we had made it to Tuesday or Wednesday, I think we would have seen defaults, down the spectrum. So mortgage lenders, broker dealers, and then from there you start having financial system risk that I don't think the Fed had any idea that they had triggered, but things were happening so quickly, and all of the markets were crashing at that time, if you recall, right? It was commodities, stocks, and bonds were being flushed down the toilet basically, and if the Fed came in and basically bought some treasuries, but mostly MBS. So we were kind of just suddenly at the epicenter of the Fed's moves to save the financial system. And even the adverse market fee, right? That was a disruption that came in late in the year last year, and threatened to basically pull 50 basis points out of the pocket of every lender. Like at the time when volume was higher than it had ever been, and the MBA stepped up and got that pushed back, 3-4 months. So that was a big move there. And Rule 4210, that's been the boogeyman out there for smaller mortgage originators for the past 4 years, just keeps getting kicked down the road to the point now where I think it's palatable. And we've all, after going through the pandemic, it almost seems like nothing, but it wasn't the right time 4 years ago, and the MBA listened and understood that. And so all the MBAs got together and got some of that stuff pushed down. And I think still making some efforts with some of the PSPA, other PSPA items. I don't know how many of those will, I think they're all being considered. I don't know what changes will happen there, but at the very least, we have a voice at the table, and we feel like we're, as an industry, we're listened to.
Right. No, I couldn't agree more. Well, hey, Jim, thanks for joining us today on Connect. Really great to chat with you. And, I'm sure you're going to be at the Western Secondary here in August in a few months. So if you want to check in with Jim, you'll see him in person there in Dana Point at the Western Secondary in August. Jim, thanks again.
Thanks, Dustin. Thanks, everybody. This was fun. I appreciate it.
Yeah. And if you enjoyed the conversation, make sure and subscribe to us here on our YouTube channel. You can also find us on Apple Podcasts, SoundCloud, Spotify, and then we'll be back again next Monday for another episode of Connect. We'll see you then.